Number 2, Middlestat Inc. buys 60% of the outstanding stock of Sherry Inc. Sherry owns a piece of land that cost $212,000, but had a fair value of $549,000 at the acquisition date. What value should be attributed to this land in a consolidated balance sheet at the date of takeover? Would it be 549? Would it be the 337? Would it be 127 or 421.8? On the balance sheet date, do we include 100% of everything? We do, and we show in the equity section that portion that's non-controlling. Right? Remember how we added everything in its entirety and only took out some amortization or the allocations? Everything's at 100% in the balance sheet, but in that stockholders' equity section, we're going to show the portion of the non-controlling interest. Okay? So the correct answer here is when we buy this company and it has a fair value of $549, we're going to adjust all those allocations to show the new value, $549. Number 3, Jordan holds 75% of the outstanding stock of Paxson Corporation. Paxson currently owes Jordan $400,000 for inventory acquired over the past few months. In preparing consolidated financial statements, what amount of this debt should be eliminated? Any intra-company transactions between the two companies need to be wiped out because we're showing it as one. So if that subsidiary owes the parent $400,000, we got to get rid of that. Okay? Because that's just between the two of them. We're trying to show a united front. Okay? So if Paxson owes the parent $400,000, when we present a united front, we can't show that $400,000. They're one company. Think of it like this, guys. Augsburg, they present, well, that's not a good example, but let's say 3M has a, financial statements. Let's just say one department needed to borrow some funds from another department. Let's just, in simplistic terms, everyone had their own budgets, they needed to borrow money. That's just between themselves. From the outside, do they owe anybody on the outside? It's the same concept here. Since we're treating it as one company, we want to eliminate anything between the two of them. That really isn't applicable. Number 4. Number 4 says, on January 1st, Brendan Inc. reports net assets of $760,000, although equipment with a 4-year remaining life has a book value of $440 and it's worth $500,000, and an unrecorded patent is valued at $45,000. Hope Corporation pays $692,000 on that date for an 80% ownership in Brendan. If the patent is to be written off over a 10-year period, at what amount should it be reported on the consolidated financial statements at December 31st of 2015? This is what I think they were trying to get at on the PowerPoint slide. They were really covering 2 years, although it doesn't look like it to me. In this scenario, what we have to do is show the patent had a $45,000 value. It's saying The patent is to be written off over a 10-year period. So it acquired it January 1st of 2014. They're asking as of 2015 of December, 2 years, what should we show that patent to be on the consolidated financial statements? So what's 45,000 divided by 10? 4,500. We need to amortize that 4,500. First year, it went down 4,500. The second year, it went down 4,500. So shouldn't it be on the books at 45,000 minus our amortization of 9? As of the end of December 2015, okay? Because it's been 2 years. That makes sense. Are you guys following me? Okay. Now, let's look. Now you see they gave you way too much information, didn't they?
Yeah, they're trying to confuse you.
Yes. Doesn't take much. Number 5. The non-controlling interest represents an outside ownership in a subsidiary that is not attributable to the parent company. Where in the consolidated balance sheet is the outside ownership interest recognized? You better get this. I'm just going to pack up and leave if you don't. Where did we say the income gets reported at 100%, but there's a piece in the balance sheet that shows the non-controlling interest? Where is it? Who said it? Okay, I don't have to leave. The owner's equity section. Guys, don't forget that. Okie doke. Owner's equity section. If someone was going to say in the mezzanine section between liabilities and owner's equity, get it? Mezzanine. Number 6. On January 1st, 2014, Chamberlain Corporation pays $388,000 for a 60% ownership in Neville. Annual excess fair value amortization of $15,000 results from this acquisition. On December 31st, 2015, 2 years later, okay, Neville reports revenues of $400,000 and expenses of $300,000. And Chamberlain reports revenues of $700,000 and expenses of $400,000. The parent figures contain no income from the subsidiary. Which is the way it should be. What is consolidated net income attributable to Chamberlain Corporation? What do you guys think? Want me to help you? Let's combine the revenues and let's combine the expenses. So the revenues are how much? $1.1 million?
700 plus 400,000.
Okay. So where do y'all want me to go? Over here? Do you care? So, if we take the 1.1 million, right? What are the expenses?
300,000, 400,000, so 700.
Expenses, 700,000. Is how much? 400,000? And then what do we have for annual excess amortization? 15. What does that give us? 385? Right? Then how much net income came from the subsidiary? Wasn't it 100? The income just from the revenues minus expenses, just from the subsidiary.
Yeah, it is 100. 4 minus 3.
4 minus 3. Okay? So we need to break out the non-controlling interest. So 400 minus 300 is what? Minus 300 is 100. And then we have to take into account that 15,000 amortization, right? So if we take into account the 15,000 amortization, what's their net income of the subsidiary? 85. The non-controlling interest has what share?
60%. Or no, 40.
40%. What's 40% of 85,000? 34,000?
85,000?
85,000 times 40%. 34. Don't we then need to subtract? This is the NCI share. 34. So wouldn't the net income portion be 351? Because the non-controlling interest only owns 40% of the subsidiary. So we show it all together, then we need to break out the subsidiary and show 40% goes to the non-controlling. Make sense? Kind of? Okay. Okay, let's go back and look at the book. Let's look at problem 7. Okay? Problem 7 asks us, on January 1st, 2013, Pride Company purchased 90% of the outstanding voting shares of Star Inc. for $540,000 cash. The acquisition date fair value of the non-controlling interest was $60,000. So basically they're trying to show us what 100% of the fair value is going to be. At January 1st, 2013, Star's net assets had a total carrying amount of $420,000. Equipment 8-year remaining life was undervalued by $80,000. Any remaining excess fair value over book was attributed to a customer list developed by Star with a 4-year remaining life, but it's not on the books. Star recorded income of $70,000 in 2013 and $80,000 in 2014. Each year since the acquisition, Star's declared a $20,000 dividend. At January 1 of 2015, that's 2 years later, guys, Pride's retained earnings shows a $250,000 balance. Selected account balances for the two companies from their separate operations